Welcome back, you legends. I'm Dr. Cal. Let's get right into this video. So the stock market today, guys, is up 1.06% on the S&P, 1.27% on the NASDAQ, and 0.71% on the Dow. Let's take a look at the different sectors. Really green all over the place. All sectors under green. Very typical of a short squeeze kind of a rally. We're seeing cyclicals, tech, and energy leading the market, with communication services, consumer defensive, and healthcare lagging the market. But everything really is in the green. And again, that's very typical of short squeeze rallies where everything rallies. Now let's take a look at the stock market map. A few pockets of green, including Apple, following the news of very strong pre-orders for its iPhone 14. And then we have Amazon in the green, as well as oil and gas exploration and production. Utilities, consumer defensives, and healthcare somewhere in the middle. Really, the most defensive sectors in the market are not leading anymore. We're also seeing muted action on big cap tech like Microsoft, Google, and Meta, as well as semiconductors. Now let's take a look at the daily chart for the S&P 500. At the close of today, guys, we're sitting at a very critical level. We're now sitting at the 20-day moving average, at the 125-day moving average, as well as the 50% retracement level from the top of this move to the bottom of this move, as well as the 38% retracement level from the top, the stock market top, all the way to the June bottom. So we're sitting at two critical retracement levels and two critical moving averages. We're also entering this red box of trapped supply. This is trapped supply, guys. We had a lot of consolidation at this zone and we had this blow off top, right? We had this gap and run in the S&P 500 following last month's CPI read. And we do have CPI coming in tomorrow. So really all bets are off. We could see a gap and run. We could see a gap and crap. We could see just more chop. It's anybody's guess, but we do have a lot of trapped supply up here, guys, that will likely take advantage of any move to the upside to sell into it. We're also sitting at a very critical level on the PPO. We're getting very close to a bullish crossover. So again, CPI tomorrow is going to make or break this counter trend rally. Let's take a look at our friend the HYG, the high yield bond. This is one of my favorite leading indicators. Divergences between the S&P 500 and the HYG have marked prior stock market tops, as well as this stock market bottom and counter trend rally. I'm not going into too much detail on this signal. I've talked a lot about it in prior videos. Please check out my previous video where I explain how this signal works. But as of right now, guys, I'm not seeing a divergence, right? We're still seeing higher highs on the HYG as well as the S&P, but we can clearly see a huge difference where the price action on the S&P 500 is so much more bullish than the HYG, right? We have a couple of indecisive candles here, a couple of dojis. Both of them are red, while the S&P is showing massive strength. So this is very interesting. It's not a divergence yet. I'm not seeing a divergence just yet, but I'm seeing big money, the big money in the bond market, being so much more cautious heading into that CPI print tomorrow. Now let's take a look at the VIX. Surprisingly, guys, look at this. The VIX has actually made a new daily high today, despite the move up in the S&P 500. This is very atypical. This is not typical at all. When the stock market moves up, we expect the VIX to move down because the VIX, guys, is a byproduct of put option premiums, right? So it's a byproduct of the premium we pay for downside protection. And we're seeing the premium moving up, which means that more and more participants are buying puts, pushing the price of puts to the upside. Now, I did see something like this before, and I was wondering when it happened because this is a rare occurrence. And I found it, guys. It happened back here in the NASDAQ top back in November 2021, right? We had this really strong day to the upside while the VIX was actually moving up. We had another up day and the VIX moved up even more. And on this last leg of the rally, we saw the market moving up and we saw even more hedging. Now, this chart, guys, down below is for the triple Qs, not the S&P 500. But I found the exact same behavior on the S&P 500 as well. Vast majority of the stock market, including the NASDAQ and the NYSE, topped here in November, as well as the ARK-K fund and the IWM. All of those indices, guys, topped in November. Following that, we had a significant period of choppiness. The S&P 500 topped here in early January, and then we had the beginning of the bear market. So this dynamic, guys, this push-pull dynamic where people are buying stocks and hedging, buying a lot of put positions, indicates to me so much uncertainty about what's going to happen over the next couple of months with inflation and the Fed. And so I expect a lot of choppy trading over the next couple of months. We'll see. Now let's take a look at the triple Qs, guys. Right on the money, we closed right at this prior support line, now a resistance line. If CPI comes in hot tomorrow, I expect a rejection of this line. And if CPI comes in bullish, meaning below expectations, I actually think the triple Qs will continue to rally significantly into this gap right here and this significant resistance line. We're getting very close to a bullish crossover on the PPO. We haven't gotten there yet. But again, depending on what happens with the CPI tomorrow, we'll either see a rejection and a move to the downside, some choppiness, or we could see a really violent short squeeze. Now, I did actually, guys, publish a member-only video for the Discord trading community to explain how I'm approaching the CPI print tomorrow, what I'm expecting, and my trade plan. It's 20 bucks a month, guys. If you want to support me, you can do that, and I do post every single trade and investment as well as live technical analysis every day in the trading community. You can check it out. The link will be in the description below the video. Now, another interesting thing, guys, that I did notice is this declining volume. So faith in the rally is declining as we've been moving up. We've also left significant gaps that could be prime targets to fill to the downside in the back half of September. And remember, guys, the back half of September tends to be significantly more bearish than the first half. We do tend to see this counter trend rally in the first half of September. And then in the second half of September, we tend to see significant selling come, even taking out prior lows in the first half of September. I'm also noticing the same thing on the triple Qs, guys. Really, volume has been declining ahead of that CPI print, which means less and less traders actually have faith in this rally. And that could influence market action in two completely different ways, guys. When fewer and fewer people have faith in a rally, and then we have fundamentally strong news like a very bullish CPI, you see all of those traders trying to FOMO in. Fear of missing out takes over the market, and they try to FOMO in. All of the shorts close their positions, and we get a short squeeze and a FOMO run, and we get a monster run. That is very possible. The other completely different outcome is that all of these bulls that have been buying up with weaker and weaker conviction, these could up easily paper handing and selling all of their positions. So tomorrow is going to be absolutely crazy. We'll see, guys. This is the triple Qs divided by the S&P 500. This is a ratio chart, and this is a very key risk on chart to track. When the triple Qs are outperforming the S&P 500, it indicates a risk on environment. When the triple Qs are underperforming, it indicates a risk off environment. And we've now taken out this prior support line, now a resistance line. And so even if we see the triple Qs rally all the way up to close this gap and even hit this resistance line, we could see the triple Qs divided by the S&P, the ratio chart, get rejected right at this prior support line. And again, guys, that could easily create something that looks like this, a lower high and a lower high on the PPO and a double top formation. Same thing with the S&P 500, guys. We could easily see the S&P rally to close this gap, try to hit the 200 daily moving average again. And if we get rejected for a second time, the sell-off following that will be much more violent because we'll have a double top formation with a negative divergence. And these double top formations, guys, are usually followed by a very violent move. In fact, a full measured move on something like this, guys, will take us down all the way to 3,500 on the SPX, taking out the June lows. The more you will hear me talk in this video, guys, the more you will realize how uncertain this time is. And unfortunately, these times are so difficult to trade. Let's take a look at the dollar index. The dollar index has now had a significant bearish crossover. We've had a significant bearish divergence where the PPO has put in a lower high as the price action has put in a higher high. Strength in the dollar index, guys, over the past year has been a significant headwind against the market. Really, guys, every time the S&P 500 has tried to rally and then we had a spike up in the dollar index, we had a massive sell-off in the stock market. Look at this. Perfect correlation. We had a massive spike in the dollar index and a massive sell-off in the stock market. Same thing happened right here, guys. The dollar moved up, the stock market moved down. Same thing was happening right here, guys. As the dollar index was moving down, the S&P 500 was moving up. And we're now seeing the same thing happening again with the dollar moving down and the S&P moving up. Now, this near perfect one-to-one correlation, guys, does end up breaking apart towards the end of any bear market. And that's when money flows out of the dollar index and into gold. Now let's take a look at gold, and we're seeing some significant bullish developments in gold. Right, we have a double bottom formation with a higher low on the PPO, and we're getting very close to a bullish crossover. Now I was hoping for one last flush to the downside, taking out these lows, flushing out all of the stop losses, grabbing liquidity, and that, in my opinion, would be my perfect entry. But if we get a bullish crossover on the PPO, I will start to deploy my accumulation strategy. Now let's take a look at the 10-year yield. The 10-year yield is still super bullish. We're making higher lows, higher highs every single day. We've actually had significant rejections to the downside 3 consecutive days in a row as the stock market has been rallying. We've seen some trying to sell the 10-year yield, i.e. buying the 10-year note. And we're seeing rejections, right? Consecutive rejections. So to me, the 10-year yield still wants to move up, possibly all the way to 4%, which is the Fed's terminal rate. That's where the Fed is projecting the federal funds rate to sit at by the end of the year. And overall, guys, the stock market does not like yields moving up. In fact, let me show you what it looks like when yields are moving up. This orange line is the 10-year yield, guys, and this chart is for the S&P 500. As the 10-year yield has been calming down since March of 2021, all the way into late August, early September of last year, we saw the stock market move up as yields were calming down. As yields began to rise again, we had a sharp sell-off. And as yields came down, we saw the stock market move up. And as yields started to push back higher early this year, we had this massive bear market sell-off. And as the yields began to calm down again, we had this rally. And now yields are moving up. The stock market had a brief sell-off. But if yields continue to push up, guys, eventually this rally will have to fizzle out because high yields on bonds make bonds way more attractive, and so big money will want to move out of stocks and into a lucrative high yielding bonds, especially if the Fed is going to stop raising rates after 4% and start to cut rates after that. That means bonds are now historically so cheap and very attractive for big money, much more so than the S&P 500, which could start to see significant declines in earnings. Taking a look at the 2-year yield, the 2-year yield is a much faster yield and it's showing even more bullishness in comparison with the 10-year yield. We're making new highs nearly every single day now, guys, moving up very sharply. And we haven't even managed to get a bearish crossover on the PPO. So this is a very bullish move to the upside. And I really can't see the 2-year yield stopping until we hit the 4% mark. And a sharp movement up in yields with a sharp movement up in stocks really doesn't work. One has to break and there's nothing to stop yields. And so I suspect that we will see a lot of chop in the stock market. This is the XLU, the S&P 500 Utilities ETF. It is one of the most defensive sectors in the stock market and really one of the very few sectors that is green year to date. And look at that. We hit a new all-time high today. This does not really bode well for the stock market. You don't want to see new all-time highs on one of the most defensive sectors, not what you really want to see in a rally. And so I took a look at the XLU divided by the S&P, the ratio chart, and we did have a nice rejection candle last week that indicated that we could see the S&P 500 begin to outperform the XLU, the Utilities ETF. But we're seeing a relative outperformance of the XLU ETF picking back up today. We have a bullish crossover on the PPO, and so it really all comes down to tomorrow. If we see a bearish CPI reading, I expect this ratio to shoot to the upside, this bullish crossover to continue to move to the upside on the PPO. And if we see the opposite, the PPO could reject at the crossover point and we could move down, and the daily chart could see something like this, a tombstone formation. This is the XLY, consumer discretionary, divided by the XLP, consumer defensives, and we're seeing some really bullish action here, guys. We have this cup and handle looking formation. We do have a bullish crossover. We're seeing the movement to the upside accelerating, and we're now near the top end of this consolidation zone, right ahead of that CPI print. Again, that CPI print comes in bullish. This cup and handle formation will materialize in a full measured move that takes us back to the early April highs. This means Amazon and Tesla shooting up to the upside. Now, the other way this could play out, guys, we could see this ratio stall at these levels and in fact reject, and that will create a very, very bad looking, very bearish looking double top with a significant bearish divergence. So again, CPI, CPI, CPI. Now let's take a look at the fear and greed reading. We're sitting at a neutral reading as of right now, guys. Stock market momentum, we're getting back to that 125-day moving average. If we manage to overtake it, that's bullish. If we reject, that's bearish. Stock price strength is weakening even though we're rallying. McClellan volume summation index, this is a breadth indicator. Breadth is picking back up. Put to call ratio is moving down. So overall, that is bullish, but keep in mind that when the put to call ratio is moving down, it indicates that puts are cheap, and so it makes it even easier to short the market. And actually, guys, we may be able to draw a support line here now, I'm noticing. And so again, we need to see the put to call ratio push back up for the bears tomorrow. And if you're bullish, you want to see the put to call ratio continue to see pressure. The VIX, again, guys, the VIX is doing some really weird things, right? We're seeing the VIX move up even though the stock market is moving up. That's a very rare signal, guys, and usually it's followed by a lot of choppy trading. Safe haven demand is actually declining. We're now seeing stocks beginning to outperform bonds again, and that really explains this bullish move to the upside on the S&P, significantly outpacing this move in the HYG. So stocks are indeed outperforming bonds. We're seeing that. And at the same time, guys, we're seeing junk bonds again beginning to outpace investment grade bonds. The yield spread is now declining, and that's actually bullish. It means more risk taking. So guys, the fear and greed index right now is looking bullish. The S&P 500 price action is looking bullish. The VIX, on the other hand, is looking bearish. And the hedging data that we saw last week is looking super bearish, and we're sitting at resistance. So if we take a weight of the evidence approach, we're really at 50-50 as of now. And that goes fairly well with seasonality, right? Because the first half of September tends to be more bullish than the second half. And also keep in mind, guys, that September the 21st, this vertical green line, we will have the Fed meeting coming up. This is the hedging data that I was talking about, guys. I talked about this hedging data in my last video. As of right now, we have $8 billion worth of put options that have been bought that will expire by the end of this week versus less than $1 billion worth of calls. So, I mean, that's just insane. A ratio of 8-to-1 towards the bearish side. Big money is so extremely bearish. This looks kind of nuts, actually. Now, this chart says that the hedging was 3 times more extreme than in 2008, but you have to keep in mind that the overall stock market valuation has gone up significantly. If we divide those option premiums by the stock market valuation, we actually get something more reasonable, but we're still at near 2008 record highs in bearish sentiment in terms of options positioning. And guys, the last time we saw something like this, we actually had more selling, and then we had that capitulation come in just a couple months later. This also goes along with this AAII bull bear sentiment reading at 53 0.3%. Just 18% of market participants are bullish. The vast majority are bearish. And these kinds of setups, guys, this extreme bearish sentiment as well as this extreme bearish positioning creates really fertile grounds for a massive short squeeze type of a move if we see a bullish CPI reading. If we don't, it will just confirm the bearishness and even more people will get even more bearish. Because if we take a look at the 1 year bearish high at 59.4%, it was on the 27th of April. And if we go back to the 27th of April, guys, this was back here, right? Sentiment bearishness peaked right around here. We still had massive selling come in. We still had 2 full legs of selling that came after this peak reading. So sentiment isn't really a great timing indicator, unfortunately, but it's still helpful to look at sentiment to assess the odds of something like a short squeeze happening. Now let's take a look at CPI projections. This is the Cleveland Fed Inflation Nowcast CPI projection. These blue bars, guys, are the actual readings. These yellow bars are the Fed projection. And if you notice, guys, on the way up, the Fed underestimated inflation. And on the way down, it may be now overestimating inflation. We'll see. But if you notice, guys, over the past 10 months, every Fed inflation forecast was below the actual reading. Every yellow bar was below the blue line. The only exception was last September where it matched actual inflation. And then July, it overestimated inflation. And so we do have the August reading coming in tomorrow. The forecast by the Fed is at 8.2 for the headline and 6.25 for the core. Now, if you notice, last month core inflation was at 5.9. So a 6.25 core inflation would be extremely bearish. That would not go along with the bullish thesis that inflation has peaked and that the Fed can start to cut rates maybe by the middle of next year. If the sticky part of inflation, if the core inflation continues to stay high, the Fed will have to do more. Because really, guys, going back 100+ years since the inception of the Fed, inflation has never come down when the federal funds rate was below CPI. And as of right now, the federal funds rate is at a quarter of the CPI and at 1/3 of the core CPI. And the Fed's plan is to raise rates high enough so that the federal funds rate will be higher than the core CPI. Not even the headline inflation number, just the core CPI. And if the core CPI, guys, continue to be sticky and stick around 6.5, 6.2 towards the end of the year, the Fed will need to raise rates even beyond their projections of 4%. And that will be extremely bearish. And that's why I'm really worried about choppy stock market trading over the next couple of months, where we will probably see CPI continue to come down, really driven by lower energy prices, lower gas and oil prices that have been driving CPI up over the past year and now are driving CPI, at least the headline number, down, but not the core number. The core number is made up of things like utility bills and rents, and these things are not slowing down, unfortunately. So if they continue to move up, core CPI will have to stay high and the Fed will have to do more. Max pain for this week is still sitting at 405. This is where the vast majority of option contracts will expire worthless. This is where big money market makers make the most amount of money, is when the vast majority of options expire worthless, and that's still at 405. This level, guys, changes in real time. It changes every day, but it's still sitting at 405. It's still at the same level that we've seen last Friday. So we're not seeing max pain move up. And usually, guys, when we see rallies, we see max pain move up with the rallies. And we're not seeing that as of right now. Again, we will see what happens tomorrow with the CPI. In terms of economic events this week, guys, we do have CPI coming in at 8:30 tomorrow before the market opens. So expect either a gap up or a gap down on the market, or maybe you just open flat if it's a mixed reading where CPI comes in significantly below expectations, for example, while the core CPI comes in at expectations or slightly higher. That could lead to significant choppy trading. We'll see. Wednesday, we'll have the PPI. PPI, guys, tends to front run CPI. So if we see another bullish reading on PPI coming in below expectations, the market will like that. Thursday, guys, we'll have the retail sales. Stocks like Amazon and Tesla, as well as Apple, will be moving on this kind of news. And Friday, we'll have the consumer sentiment index coming in. Next week, guys, we do have some housing numbers, but the most important day is going to be Wednesday, when the Fed comes out with its economic projections as well as the interest rate decision. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.